Hi there! So, our new topic for today is still partnership formation 2, but this time it's case 4, wherein two sole proprietor merge into business or into partnership. Okay, so let's take a look. So, step in conversion of a sole proprietor to partnership. First, we need to revalue all the assets of the sole proprietor. And take note, if the income statement is still open, we need to close. And then we close all the accumulated depreciation to their respective fixed asset account. And then we record the investment of the incoming partners. So let's see. So let's assume that Igna and Rich decided to merge into their respective businesses. Igna is a sole trader of software with the following financial statement. So here's cash, 61,000, accounts receivable, 75,000, supplies, 2,000, prepaid rent, 0, and then computer equipment, 25,000, accounts payable, 0, Igna equity, 100,000, service revenue, 175,000, utilities expense, 34,000, salaries expense, 50,000, Igna withdrawals, 10,000, rent expense, 30,000, supplies expense, 3,000, depreciation expense, 6,416.67, accumulated depreciation, same as depreciation, salaries payable, 10,000, unearned revenue, 5,000, and then income, 51,583.33. So, if you would see, it's the same with the income statement. Okay? So, Rich has a consultancy business with the following financial statement. So, cash, 25,000, accounts receivable, 15,000, prepaid insurance, 5,000, building, 150,000, land, 50,000, mortgage payable, 75,000, Rich equity, 100,000, service revenue, 105,000, utilities expense, 14,000, salaries expense, 35, supplies expense, 1,000, and then depreciation expense, 15,000. Accumulated depreciation, 15,000. Salaries payable, 10,000. Unearned revenue, 5,000. And then net income, 40,000. So, both has the income of 40,000. Okay? So, let's first close all their respective nominal accounts. So, what is the nominal account again? These are our income statement account. Okay? So, let's see the two books. So, for Igna's book, we have to close service revenue, 175,000. Debit because it was credited. So, when we put it on a debit side, it will put those balance into 0. Okay? So, we have utilities expense, credit, 34,000, salaries expense, 5,000, rent expense, 30,000, supplies expense, 3,000, depreciation expense, 6,416.67, and Igna's capital, 51,583.33. So, to record the closing entry of the nominal account. Take note, we also need to close withdrawal account because withdrawal account is a temporary account. But this withdrawal account is close to Igna capital. Because the upper part could be close to income summary account if you don't want it to be direct. But this one, we just put it on a direct. Okay? Next, we have Igna capital, 10,000 and Igna withdrawal, 10,000. Credit. So, for Rich book, it's the same. We debit all the revenue account and credit all the expenses account. Okay? Next, so additional information. And take note, after that, we already closed the book. We need to record their respective fair market value because under the partnership, all assets and liabilities should be recorded at fair market value. So, we need to revalue according to their agreement. So, Rich and Igna agreed on the following to arrive at the fair valuation of the asset of the sole proprietorship. So, allowance for bad debts should be 10 and 15% respectively for accounts receivable for both Igna and Rich. So, supplies has a fair value of 20,000 and then prepaid insurance to be recognized as worthless. Building is depreciated by additional 10%. Take note, it's additional 10%, not should be. So, sometimes you should be careful with that because sometimes those two has a different effect. Next, partnership will assume the liability for mortgage of the building while salaries payable and unearned revenue is to be shouldered by the respective partners. So, allowance for bad debts should be 10 and 15% of the accounts receivable per IGNA and REACH. So, let's see. So, allowance for doubtful account, take note, both has zero beginning balance. And take note that for IGNA, it's 10% of its accounts receivable, which is 75,000. So, that constitutes 7,500. So, since we have a zero balance, and take note, accounts receivable is a balance sheet account. So, we go for our balance sheet account, which is also our allowance for bad debts. That's why we have 75,000 times 10, 7,500. But take note, if it is 10% of sale, what we will be able to get is not the allowance for bad debt. Instead, we will get the bad debts expense if it is an income statement account, but for this one it's a balance sheet account. Okay, next for reach we have 15,000 accounts receivable times 15, we have now 2,250. So we record. So take note, IGNA, that we debit IGNA capital 7.5, and then since we increase allowance for bad debt, which is a credit side, we credit allowance for bad debt 7.5. This is for IGNA's book. And for Rich book, we have to record Rich capital 2,250 and allowance for bad debt 2,250. Just the same with explanations. Okay? So we have supplies has a fair market value of 20,000. And take note, if you will go back, the supplies account only include in the book of IGNA. So take note, there is a balance of 2,000 and it says that the market value should now be 20,000. So therefore, supply has an ending balance supposed to be of 20,000. So we had to put an adjustment of 18,000 to increase our salary. Our supply, sorry. So we have now supplies 18,000 debit and then credit IGNA capital 18,000 because it's an increase. And for Rich, there's no supply, so we just put no entry. Okay? So next, prepaid insurance is to be recognized as worthless. So meaning we would have to zero out. On IGNA's book, you would see there's no prepaid insurance. There's a prepaid rent, but it is zero. For Rich books, we said it is not to be worthless. And we will be able to see that there is a balance of 5,000. So we need to what? To put a credit of 5,000 to make it zero because it's not anymore to be recognized since it's worthless. So we debit Rich capital 5,000 and credit prepaid insurance 5,000. Okay? So next, this time, building is to be depreciated by additional. Take note, it's additional, not by 10%. It's an additional by 10%. So we need just to increase. So since in IGNA's book, there's no building, we just go for Rich. So we have the balance of 15,000, balance from the formation, and then take note we had to put additional 10%. So 10% of 150,000 it's 15. So therefore we already have 30,000. So Rich capital 15,000 and accumulated depreciation building 15,000. So now we would see that all the income statement and some adjustments are being reflected, then IGNA's capital has a balance of 152,083.33 and Rich capital has 117,750. If you would check all our adjustments and then the income, but this only include for the capital account. Now, next, they said that we would use new books. So for new books, the step is for the sole proprietor to partnership. Number one, we revalue the asset to reflect the agreed value. We already do that. We close the book of each of the sole proprietor. And then we open the partnership book to record the investment. So we need to close all the accounts. So we debit all the credit accounts and debit all the credit or the equity and liabilities, and then we credit all the assets account, as you see, for both. So we close. So for IGNA, we have allowance for bad debts. Remember our adjustment, it's 7,500. Accumulated depreciation, 6,416.67. Salaries payable, 10,000. Unearned revenue, 5,000. And then IGNA capital, 152,083.33. Cash, 61,000. Accounts receivable, 75,000. Supplies, 20,000. And computer equipment, 25,000. Okay? So for rich book, we have allowance for bad debt, 2,250. Accumulated depreciation, 30,000. Salaries payable, 10,000. Unearned revenue, 5,000. Mortgage payable, 75,000. And rich capital, 117,750. We credit cash, 25,000. Accounts receivable, 15,000. Building, 150,000. And land, 50,000. Okay, so if you would post that on each of its T account, you will see that all the accounts now are zero balance. Okay, now let's see. What if book of one of the sole proprietor will be used? So meaning old books will be used instead of a new books. Okay, so let's see the step for the conversion of the sole proprietor to the partnership using an old book or one of the partner's book. So number one, we revalue the asset to reflect the agreed value. We already do that. We adjust the book that will be used. We already adjust Igna's book. And then record the investment of the new partner. Okay, so first, we close book of Rich because we will not be using anymore the book of Rich. So we debit all the credit accounts and debit and credit all the debit accounts. Okay, so we record the investment of the new partner. So in Rich book, we have to debit cash 25,000, accounts receivable 12,750. Why? Because we already deduct the allowance for doubtful accounts. So 15,000 less 2,250, we would arrive at 12,750. Building same. It's 120 because it's 150 less 30,000. And then land 50,000. And take note, we did not record any of the unearned and salaries payable because as agreed, it will not be assumed by the partnership. Hence, it will be borne by Rich herself. So we debit mortgage payable 75,000 and Rich capital 132,750. Okay? So let's see the balance sheet. If you would check, it's the same for cash, 85,000 for both. New books are used and Igna's book are used. And then accounts receivable, the difference is the allowance for bad debts because take note, we did not close the allowance for bad debts on Igna's book. And then also for computer because we did not close the accumulated depreciation on Igna's book. So the difference will just be this two. And the same and anything else is just the same. Okay? So hopefully you learned something. And if you like this, please help me reach out more people by hitting the subscribe and the like button below. God bless you. If you have questions, just comment it below. Bye!